Hello everyone. My name is Kamal Manocha. I represent PMS AIF World. Before we start this webinar, I would just like to give a quick context to another very interesting and very intuitive webinar that we have planned. We are in a phase of economy where now there is no doubt that there is going to be a perennial era of growth. We have seen last almost one decade where there was too much pessimism despite many ground level reforms, as well as the fall in corporate earnings, despite many analysts expecting, over last decade that soon we will see corporate earnings going up, but they kept going down and down. And overall, market was actually becoming narrow and it was actually polarized. And in such a risk averse environment, it is only that the space of large caps was attracting more and more capital. Also, the era of last 5 years was particularly fueled with high liquidity, and that all the more attracted money towards large caps. So more money going towards large caps actually led to the rise in valuations of those large caps and a perception built that large caps, high valuations are sustainable, which, for an argument's sake, is not a wrong thing to say because over a longer period of time, some of the well established businesses will add to their earnings and the valuations will tend to look all the more attractive. However, because of the current gap between the valuations of large caps and mid caps, the space of quality mid caps, which is ripe for becoming tomorrow's Nifty 50 or Nifty Next 50 companies, looks to be very attractive. And that sweet spot is the space that we are going to discuss today because ASK has launched its Emerging Opportunities Fund Series 2 to tap that space. So this space is all about investing into respective industry leaders in the quality mid caps through a well diversified portfolio. I have given you, certain glimpses, but for more details, we have my dear friend, Mr. Nimesh Mehta from the team ASK. Nimesh is a TEDx speaker, is an author and director and head of products and sales at ASK Investment Managers. Without taking much time, I would like to hand over to Nimesh for him to begin with his presentation on ASK Emerging Opportunities Fund, followed by which we will have Q&A.
Thank you, Kamal. I'll just do one check. Is this now seen? Can you see?
Yes, absolutely visible.
Okay, perfect. Thank you so much, Kamal, for the nice words and setting the context for the presentation. But I must thank you and the PMS AIF world for continuously doing it's a relentless set of webinars again and again with different set of people to educate your investors. And I must really appreciate that work which you and your team does it on an ongoing basis. So we take this opportunity and thank you for giving this opportunity for us to represent of our new emerging fund. But before I get into the product and platform, and since this is an education platform, I would like to share how an investor should actually choose any equity manager. And I will use my 20 years experience and the ASK's experience which you have to help you do that. So this is what I always call the 6 P's of selecting an equity manager. And we've been talking about this for a decade now for all our clients. And those 6 P's would come out to be the people, the philosophy, the product, the process, the performance, and the personalized customer service. I'll just try to put it down. Yeah. We will spend some time here, but for us, product and platform are just one of the ways to come upon, talk about our philosophy and the work we do at ASK. So let's start with the first P, which is people. Now, everyone will agree here that people are an important part of any business, but in the investment industry, people are the only differentiating factor because the long-term success of an investment performance is depend on the people's wisdom, the knowledge, and the experience and the track record. And therefore, what I'm going to represent today is if you were to evaluate ASK, then who are the people who are managing there? So it gives me a lot of pride to share that Mr. Bharat Shah, or called as Bharat Bhai in the equity markets, is the only equity manager in the country, to our knowledge, who has a 30 years of public track record. And there's very difference between public. So about 10 years when he was in Birla Mutual Fund and CEO and CIO, and the last 2 decades at ASK. To our knowledge, he's the only one whose public track record can be measured. Along with him is Mr. Pratik Agarwal, who's one of the most hands-on chief investment officer and business head, who leads a 10-member research and investment team with average experience of 15 years. So about 20 years, about 50 years between two gentlemen here, and about 150 years, a total investment experience of about 200 years is focused only on the PMS and AI business. And that's something you all must recognize and consider, that how important it is, the experience and the people. And as we move forward, you'll understand how this experience shapes up. Second part on this slide I want to touch upon is that we were the first to start PMS way back in 2001. The oldest PMS was started in 29 Jan 2001, and I'll talk about it therefore. The third part is that not only we are the oldest PMS manager, but we are the largest PMS manager or alternate manager with about 30,000 crores of asset under management. Now, we don't take pride in being the number one in the country, but we take a lot of pride in the what we say is the 30,000 crores of trust. Because the entire investment business about trust, and how we manage your money, how we manage your risk is all about on a long-term return, is a function of the trust we have. And the pride in the 21 years track record is the trust which we have of our clients for the last more than 2 decades there. The fourth thing I want to touch upon is a purely bottom-up stock selection approach. We just don't go top-down, and I'll touch upon this as we move forward. Having seen this, we've done this for more than 2 decades. I'm happy to share with you that Blackstone Group is the largest global alternate asset management firm in the world, took about 71% stake in the company. So the trust which we have built both domestically and offshore was in some way a proof of what Blackstone did by taking about 71% stake in the company. So that's about people. The second P comes, with time, with experienced people comes a very time-tested, simple style of investing or philosophy of investing. And here is where the crux of the core of ASK is in the next 5 to 6 slides, which I'm going to talk about there. And I promise you, as an investor, if you listen to it attentively, you'll understand why you have created wealth in equity market or why you haven't created. At ASK, we define our philosophy as first as capital preservation and second as capital appreciation, and in that order. Our mindset is to first preserve, and I think we are the only manager in equity manager in the country who puts capital preservation as an objective in both our AIF or the PMS platform. Now, there are 5 attributes I'm going to touch upon pretty quickly, which will help you decide that why you made money or why you didn't make money. The number one is the size of opportunity. Unfortunately, everyone in the industry is focused on talking about size of the fish, whether you're entering a small cap, mid cap, and large cap. Today, I'm going to represent that why small and mid cap is there. But to us, it is never about the size of the fish. It's always about size of the pond. As investors, when we invest into equity markets, we look at how big the company was or how big the company is. But both are a rear view mirror driving. You're looking in the car and looking on a rear view mirror and driving there. But the way to is to look forward how big the company can become. Unfortunately, as investors, when we start, we always get carried away by the past and the present, but that's not at all important. It is also not important, which I talked about, it's about how big the fish is there. If you can imagine in terms of size of the pond, we keep growing the size of the pond, then whether it's a small, mid or large, each one will give. And today, I'm going to share with you a live example to prove this point. And therefore, the first thing we say on this point is the debate between large, mid and small is all artificial one. Market has no recognition, no understanding of the large, mid and small. The difference between each of those companies is whether quality and lack of quality. And I'll give an example to that. The second part is the quality of business. Now, here is where we say route to preservation of capital happens from buying into business with high capital efficiency. We call capital efficiency, we measure it by return on capital employed. And we say return on capital employed is the character of the company, which does not change with time. Some businesses require capital at all points in time. And so let me simplify for the investors out here. When you put your own money, 100 rupees, and you get 20 rupees back, then ROE is 20%. But in most businesses, you borrow and put another 100 rupees as debt or a bank your loan, you took it there. On that 100 rupees, if you got 5 rupees back, the total invested capital is 200, 100 plus 100. And the return you got is about 25, which is 12.5% ROC. Now, here is where, if you go back in history and study, where have you lost money? We have lost money in infrastructure companies, power companies, commodity companies, the hotel company, airline companies, construction company, all of these companies, real estate company, all of these companies have capital efficiency, sometimes negative or always in the range of a single digit or a slightly higher double digit. And therefore, imagine if the business itself doesn't create long period compounding or long-term profits, then how is in terms of we as an investor? So it is very important to be timing in this business is more important than timing. And sometimes timing in the commodity cycle may earn much more returns than being there. But we are not in that space at all, because a lot of money, even today when you talk about, I was in Surat, Gujarat a few days back, and I saw people still hold on to the JP Associates Unitex of the world, which are down 95, 98% from its peak out there, and the capital efficiency is very, very poor. So if I were to, evaluate, about roughly 6,000 companies are listed in India, and if you were to evaluate 25% ROC businesses only, which I was asking investors and businessmen also, will you invest in or start a business which will give up ROC of 2 or 3%? They were laughing at me. But when it comes to investing, we put into JP Associates and Unitech of the world. I'm again repeating there, because there's a two dichotomy which happens. When you start your own business, you're saying, no, I have high capital efficiency. But when you invest in the equity markets, you have a very different view that, it can be lower capital efficiency. We don't focus on that. So one of the first messages from my side is also there, that investing in your own business or investing in other business is the same. Investing in equity market is the same. And therefore, so highlighting a point that out of 6,000 companies in the country, if you were to evaluate only 25% return capital employed businesses, the businesses come down to only 205 companies. So in simple language, our universe will shrink to about, if it's a 20%, about 300 odd companies. If you take a 15% also, about 400, 500 companies. So universe shrinks down to, because we don't want to get into businesses which in their own businesses have a poor return capital employed. Now, the third part is the quality of management. Now, this is very important. How do we? We'll tell you two ways. How do you judge a management? One is by objective way and subjective way. Now, what is in the previous slide, we touched upon the money which comes in, every return on business which you got there. Now, where is the capital allocation happening? This is what it happens there. And I must highlight that the market does not like conglomerate complexity. It actually gives a lesser valuation than it gives to focused businesses. And let me give an example. In the study we had done on a 10-year basis, in 2010 to 2010 period, Infosys and Wipro delivered a EPS growth about 25%. But if you look at the the price growth of Infosys was up 19%, and the price growth of Wipro was about 10 to 11%. One of the reasons that we could attribute was that Wipro had a lighting, consumer, FMCG, all businesses a part of the IT behemoth it was, and therefore the day they segregated and separated, hived off each of the businesses is when they started to get the recognition in line with the IT industry in the coming future. And similarly, Bajaj Auto, if you look at there, it housed into the treasury and finance business was within that. The day it simplified and got the business outside, Bajaj Finance came outside, and Bajaj Finance is today. So market lapped up both the businesses, and today Bajaj Finance is 5 times the value of Bajaj Auto. So market likes focused businesses. Most of the business we are investing into, Asian Paint, Pidilite Industries, PI Industries, all of those companies are there, are very focused businesses, and that's one way of evaluating. The second way is also we say that each management has its core competency, and we should stay away from trying to do. The management could be right in doing that. They want to spend money, but we would prefer to own only companies which has investing into the capital allocation, the same businesses. And therefore, one of the examples which I keep giving in my client presentation is Vijay Mallya, who actually had a great spirits business, but all the money he put into the airlines and into the sports business, and eventually became a minority shareholder, or I don't know what his shareholding pattern is into his spirits business out there. But that's what happens when you deviate from, because crying businesses, or like what Peter Lynch says, crying babies get more attention. The businesses which you don't understand typically take more. And if you look at airlines, which is a high capital guzzler, and it eventually hurted him. So he may be right in doing that, but we investors to really focus around there. And in 2008-9 period of time, we saw telecom people starting to have the real estate business, real estate guys starting tire business, and so on and so forth. Completely uncorrelated business. The second part again comes from the wisdom of Bharat Bhai, Pratik and all. We invest into public equity. So what happens is there every quarter the management gives a result, and when they give results, they tell us that what they're going to do in the coming quarter, coming year. So one of the best ways to measure is in terms of what they have delivered by measuring them a quarter later, 6 months later, 1 year later. And it is one of the simplest way to test whether the company, the management can do walk the talk or not. You're able to see the ethics, integrity, vision, execution, everything can be done because we are not in terms of hurry into get into. And here, if I can say, a lot of people asked us, why are you not into the so-called Zomatos of the world? We say, let the company prove its mettle in the live after it listed out there, and we'll get outside in there. So that's the way you look at quality of management. The fourth attribute is earnings growth, and Buffett has beautifully put here, his price is nothing but slaves of earning and relentless growth over time. We at ASK talk, it's an umbilical cord relationship between the earnings growth and the investment returns or the stock price movement out there. And I would like to highlight that in a shorter run, there could be there could no correlation between the earnings growth and the stock price movement out there. But if you expand your investment horizon between 5 to 7 years, as long as 10 years, you will see the earnings growth of the company and the price growth are almost similar. In one of the portfolios, IEP, we have Kotak Bank, and the last 10 years, the earnings growth of the company is 20.2%, and the last 10 years, the price growth is about 20.3%. So what are two words we focus here is predictability and consistency of earning growth. It is the most important part. So we prefer companies which can do 12, 13, 14% amount of consistent earnings growth, irrespective of market situation, then try to buy a company which can do very well in a shorter period of time. The fifth element, the last part is value. And I think, again, two parts here. One of the things which most people don't understand is that when you buy a company and a stock, then you give the price, but you're not buying the price. What you're buying is the underlying value of the company. Price is certain and upfront, but value is derived. And again, the management or again, the people comes in there because you are supposed to assess the kind of earnings growth this company can deliver, how consistently it can deliver, what is the magnitude of earnings can be, what is the certainty of earnings can be, how volatile the earnings could be over the next longer period of time, and bring it back to trade. So we always say price is a servant, value is a master. But unfortunately, whenever I go to meet clients, they will always want to say, what is the next best HDFC Bank or next Kotak Bank, and always endeavor to buy the new one there. And that brings to me the second part of my thought process here. In India, most of us have not created well because you always focus on the price to earning, price to book. And somewhere we are also responsible as industry participant who keeps giving the nomenclature. But please, and I keep saying, how many people own Asian Paints, how many people own Pidilite, Bajaj Finance, Kotak Bank, so many other banks in the country, is because largely they believe that it is the price has gone too high there. And one should not do that. To sum up the entire philosophy, which is the most important part, I spent some time. The first thing you should we focus that size of pond versus size of the fish. The second is the high ROC of the business. Third is the good management quality at the center. Fourth is the earnings growth with the consistent and predictability of earnings. And the last comes from the price or margin of safety out there. But unfortunately, when investors it starts with value and just looks out here, and that is where it always has an experience. As I told you, the experience of an investor in the country in India has been poor because it always goes through this cycle there. Now, this is a live example I want to give you. I told you to prove that the Bajaj Finance as a stock example. I'll give you what I want to share, the whole philosophy. If you look at the bottom table, it tells you yellow. It shows you yellow, blue, and green color. Yellow color means it is a small cap company by market cap. Blue means a mid cap, and green means a large cap company. Now just go to FY11. If you see here, the 2,500 crores is the market cap of the Bajaj Finance. In that year, the price change was 121%. So people say, oh, I told you, see, there's always the small cap does better. Then I take them to FY15. The market cap of Bajaj Finance was 20,000 crores. How much did it grow in that year? 131% growth in a single year. Wow, small and mid cap always does better. Then I take them to a FY21. The market cap of the company is 3 lakh crore and it grew by 132% in a single year. So, I mean, this doesn't really matter. And in a year when FY21, when the 3 lakh crore market cap, there are so many companies, India Bulls, DHFL, and so many finance companies which gave negative or didn't even grow at all. And therefore, the point I was highlighting in the philosophy part, that market has no recognition in terms of what you buy. Market recognize the quality of the business. The quality of business in this case, the risk management, the balance sheet, the people, Sanjeev Gujjar, Rajiv Jain as the CEO leader, you see it all were right, and therefore it grew. And look at the PAT growth over the last 10 years, 48% PAT growth, and the price changes 54%. It is gone ahead of the markets in the earnings growth, and this is after the downturn. Is ahead, is because market believes that the huge NBFC opportunity is still in the country, and Bajaj Finance beautifully plays out there. So markets will recognize sometimes ahead and sometimes behind, and that is where you need to focus. And this is where I move the third part of my with people, the philosophy, and we jump into the product part. I'm going to spend some time on IP, which all of you know, and you might be surprised I'm spending there, but you'll understand it's there. I'll run very faster because some of you might know it there. We did a 10-year study, and we found in India there are 4 ownership patterns: the entrepreneurship company, the public sector, the multinational, and the pure professional firm. And they were tested on 4 parameters: the top line, the operating profit, the profitability, PBIT, the PAT, the capital efficiency, which I explained to you, ROC, ROE, and actual investment value, net of capital dilution for any. Net of capital dilution means the company where it come back to again take money from the markets. And when it didn't come, that's what is there. Now, you will be surprised that on all the parameters here, the basket of entrepreneurs did much better than any other form of ownership. And that got us thinking, why is it that entrepreneurs as a category did much better? And the answer came in the own skin in the game. The entrepreneur owns 25, 30, 40, 60, 70, 80% of the own company. And therefore, the alignment of interest, the own skin in the game, the passion, the conviction, the commitment, the longer-termness, the customer centricity, the ability to spot opportunity is far higher than any other form of ownership out there. And therefore, we conceptualize this idea there. And if you look at in terms of just an example versus the entrepreneur bank versus the professional bank, since inception, if you look at there, 28,000, 100 became 28,000 versus, so 32% versus 27, it's not too bad. The second best is professional. In the last 10 years also, it has grown from 6.5 times, 6.6 times of Kotak versus 3.7 times. It all depends on the professional, who's the good CEO and how longevity it has or not. But this is just a demonstration because all of you relate to bank, all of us bank, to give you a flavor. And if you compare this with SBI has done 2.5 times in the last 10-year period of time. It's one of the best public sector banks. And MNC, we don't have a track record locally, but to give you that IP. Now, this was validated by Credit Suisse when they did in September 2018 a report which showed that when they studied the top 1,000 companies globally, they found that the family-owned businesses create wealth, even global parlance. And you simply put, Facebook, Apple, Microsoft, Tesla, all of those companies are entrepreneur-led businesses, and that's there. Now, why did I do that? Now, let me just come back to the portfolio or the AIF which you're talking there, which is the EOF 2.0 here. Now, the first thing first, I touched upon entrepreneur because we believe entrepreneur as one of the attributes we love to do it. As of today, the entire EOF basket owners or the stocks which we own are entrepreneur companies. So I've given you the name of the entire companies out here, and you see the promoter holding out here. So one of the attributes we look at is the minimum 25% promoter holding. And today we have all the companies with an entrepreneur holding. So whoever didn't get participation in the past to play in the entrepreneur story is getting a story to play in the EOF. That's number one. Number two, why is it similar? We sometimes internally say EOF has a very similar characteristics. So IP was in 2014, 15 there. And we tried to see the median market cap. The median market cap of IP was about 20,000 crores. And today the median market cap of EOF is also 24,000 crores. So the journey what we saw in IP over the last 8 years, probably believe the journey could be in terms of in EOF, and that's what the endeavor is there. For an IP investor who's already have, then he has the 56% of stock which is different from what is owned in IP, and therefore he is most likely to participate because he had a wonderful experience. But he believes that in the next leg of growth, which other company will do well, then we talk about EOF, and which are 56% different. That was the second part of the story. The third, many of the clients spoke to me that they already own a lot of mid caps and small caps in their portfolio. So I said, let us see how are we different. What we tried and done that we evaluate, we took our entire mid cap and small cap stocks and evaluated and compared with entire mutual fund industry of a mid and small cap industry only. And we said, let us see how much is the overlap from any other mutual fund. So it is very surprising. You must see this table first before I come here. On an average, only 7.3 or 7.5% overlap with the mid-cap mutual funds in the industry, and there are 4 stocks which overlap. On a highest maximum, there's 25% overlap in a single and about 10 stocks. But look at the one which largely owned by the investors, HDFC Mid-Cap Opportunity, Mire or Kotak or Axis or DSP and all. Look at the average market cap. It's about, average overlap is about 10% on the higher side. And so what I'm trying to highlight is the third point is there, EOF is so different in terms of underlying holding that it brings a differentiation from the mid-cap mutual funds we have. It brings a differentiation from IP with 56%. It brings almost a 90% difference from the mid-cap and the small-cap mutual funds you already own there. Now, have you demonstrated some kind of track record in the small mid-cap space? And therefore, I go back to IP and talk about it there. When we bought Pidilite, 8,000 crores, today about 1.3 lakh crore kind of a market cap there. Bajaj Finserv was only 8,400, today 2.5 lakh crore. When you're talking of Bajaj Finance and Finserv, as early as 2013-14 times, there was very little liquidity. There was very little belief in that this can be a great fintech story, NBFC story. And now in hindsight, we look back, I wish we could have participated there. Astral Poly at 2,000 crores, we bought about 40,000 crores. PI Industries was as bought at about 1,500 crores of a market cap, which is up about 40,000 crores today. This is just a flavor of trying to say, look at Bajaj Finance also. Can you believe it that Bajaj Finance is only 9,000 crores market cap in about April 14. Today is about 4.5 lakh crore. Asian Paints was a mid cap then. Page Industries was very early. Cholamandalam Finance. Why I'm giving you a flavor of this there, that all this story has happened in IP over the last 7, 8, 10-year period of time. And we believe, and as what Kamal mentioned, this opportunity. So this is a very important sector. Why is it that he highlighted there's a biasness towards the small and mid-cap and quality mid-caps out there? So this is a very interesting tide you must stay as time. So we believe there's a great opportunity in chemicals as a sector in the country. And due to China plus one PLI there, what we did that we focused on the average market cap of the entire sector. Can you believe there are more than about 100 odd companies listed in the country on chemicals? The average market cap of the chemical business about 12,800 crore, which means the sector itself is a small cap. Less than 16,000 crore is a small cap as an industry or a small cap company. The entire small cap, entire industry is small cap. So, what we say is that the humongous opportunity, there's a $4 trillion global opportunity of chemicals. India is only about 3%. China is 30% out there. And therefore, even if gradually 0.5%, 1%, shift happens to India, we are in a great position where the sector itself can actually move into a large cap sector. And players like Naveen, PI, Aarti, and so many companies will actually do very good. And look at in terms of the Naveen floor in about 20,000 crores as a market cap. It's a wonderful story on CRAN. It is a story on refrigerant gases, the fluoride businesses, the pharma business. It's a great story, specialty chemical story to do there. Just giving you a flavor. Again, API as an industry, 20,000 crores market cap as a mid cap. Laurus Labs about 31,000 crores, so still about a mid cap story there. If you look at consumer durable, white good, or a PLI manufacturing story, just about 15,000 crores. Dixon itself is about 25,000. Polycab, just to give you some more flavor on Polycab and Dixon, some of you know, cable and wireless industry may be growing at about 14-15%. Polycab is about 12% market share in a sector or in this segment, which is about only 20% organized. So unorganized to organized, unbranded to branded, the story comes in there, and it's a leadership. So while we enter into some of this sector, most of this company, which we are leadership in their own place. Dixon is a great story to play in the country for not only just electronics in the country, but export as a story. People tell us that it has gone significantly higher, but we measure by the growth, by the earnings of the company. Last year, the PIBIT of the company was only about 1.5% of Pigatron, which is the second largest global manufacturer of Apple. So outsource agency there. Just 1.5% of the profit it makes. So imagine the opportunity it can get in the companies like Dixon out there. Relaxo Footwear, maybe again, you can stories there. Digital is a great opportunity in Apple kind of company, 16,000 crores market cap. What it does is encourage, it's a great story on mobility, AI and data, artificial intelligence, data analytics. What does it do? It encourages investors and customers to come on mobile and do transaction. The simple question all of us need to ask, will the smartphone increase in the country? Number two, will we consume more time on the mobile phones? Yes or no? And therefore, whenever you go online and if you search something, it keeps pushing back the same advertisement to you because it encourages and pushes you to transact on online. And that data analytics play is done by Apple, and it only earns money when it makes a transaction. So it takes money from the business when there is a transaction which happens. It's a very different model and still a very niche-oriented company. And if you go back to see what IPL rights of digital has been there, it has been bigger. Digital rights has been more than what the other rights, television other rights has been there, which gives an indication that we are moving towards the digital part of there. In BFSI, it could be the market cap could be higher, but Avas Financials, a fantastic story on the low penetration of mortgage in the country, and you'd like to play. Look at the market cap out here. ROA of 2.5%, 300 branches, 12 states, fantastic business, and it is very different because you must know about Awas also is different from the banks because it plays into MSMEs or self-employed. It goes into the rural market out there where bank cannot reach out there, and the very small ticket size. So it's a beautiful play. And lastly, solar industry. A lot of people ask me what's the defense alternative. So solar is one of the largest manufacturers of explosives in the country out here, and therefore an initiating system it does. So if you want to play a story in India on infrastructure, if you want to play a story on mining, construction, coal, defense and all, solar becomes a great play to do, and this are very young. So what we are trying to say, to sum up the entire presentation, to give you this slide, is the emerging sector. The sector itself is at a small and mid, and if you are able to identify a leadership company which has its own moats, if you're able to buy in young at them, which was what Kamal spoke at the start of the presentation, that if you're able to buy them young and be able to hold on in this golden decade period of time, then there's a huge opportunity for all of us to create wealth. Now, if you look at the construct of the portfolio, it will actually have about 25 odd names, and I'll give you the right flavor. It just talks about flexi cap. So while there's a biasness and it will continue to remain there, our endeavor always is to flexi cap. But the biasness today is higher, as I explained in the previous slide. 64% mid cap, about 17% small cap, in about 17-18% of large cap is as of the market cap today. And this other kind of sectors we are present out here because we believe this is a great sector and great opportunity forward. Now, just a little bit key terms of the trade. It's a 4-year from the date of closing. We are starting raising here. So typically, we will take a 3 drawdowns. Today, when you start there, we'll take a 30 lakh on a crore rupees of investing, which is what the SEBI limit is there. We take 30 lakhs now, about 35 lakh in October quarter and 35 lakh in the Jan to March quarter of 2023 there. It also answers a very important question of the client, that how do you wither the volatility? If the volatility is withered by evening out, or taking the money in 3 drawdowns, which helps us to really even out that part. It's a long only category 3 investment. There's no close-endedness or lock-in period out there. It slightly has exit load of a higher exit load. So my simple reason to put a very high exit load is to prepare the client that you cannot take this money off. You can take the money off, but mentally be prepared that 4 to 5 years of money you're parking in ASK in the growth which will happen in the coming decade out here. So that's about a little bit of key terms on the fund. Is the pricing, which you will get to know in the product brochure. So it'll take about 5-6 minutes only to close this presentation because we're coming to the end. Because this is all just closing up. Now, process is very critical because process is the one of the barometers for a long period sustenance of performance out here, and therefore this is to be taken very seriously. And we are the only one who gives our accountability, the filtration process with the clients available there. The top 500 company represent 92% of listed universe. So once you start with that, the first is the quality of management. As I explained to you, I'm not going to spend some time with the management quality which I explained out here. The universe come down by 200 odd company, 310. Now it is about 15% ROC as a doing year. It brings our universe to about 80-90 companies out here. And since the play is in a small mid cap, we're coming out of COVID, we're trying to say that we'll have an ROC. While I'm talking of 15% ROC in this as a measure of this thing, the actual ROC of the portfolio which is ready right now is 33%, 33 or 34%. Can you believe that? Imagine the quality of business there. Then we focus on the earnings growth of the portfolio, which is talking of at least a 20% earnings growth. Let me just take you to the next slide. It's talking about 23% earnings growth as we go forward. The portfolio expected earnings growth is 23% there. It comes down universe to 95, and then depending on the good mix of the characteristics, the educated diversity, the high margin of safety, we do about 25 companies we buy with a almost equal weighted kind of concept in the portfolio there. Just there are 2 caveats here, which is asterisk out here put there. At the building of the portfolio, there could be either this not meeting or this not meeting for 25% of the portfolio. Just because they're coming out of COVID is something we're putting officially communicating, but over time it will meet the norms. And currently also as the build-up portfolio about 33-34% ROC. So build there. Now let's move forward on the performance. Remember, never choose us or never choose any manager on performance, because if the first 4 P's are right, that is the people, the philosophy, the process, and the product is right, the performance has to fall into play. And with that, I would like to share a crore invested by, I know a Malabar investor, a Malabar Health investor in Mumbai, who had put a crore, is now, even after this fall of about 15-20%, his value is 39 crores versus Nifty, which is grown at 15 times. Now, here is where, I'm just taking a couple of minutes more because, a lot of anxiety which investors has today. And therefore, let me bring this quote first here. what we learn from history is that we don't learn from history. And why do I say so at this point in time? Is because today investors are worried about interest rate. They're worried about the crude oil prices, the commodity prices. They're worried about the quantitative tightening. They're worried about crude oil I spoke about. They're worried of geopolitical tensions. They're worried of alpha is there or not there. And if you look back in the last 21 years, we had all of it. We had double-digit interest rate. We had double-digit inflation. We have single-digit there. Crude oil $150, bring it down to $20. USA quantitative easing we saw. We Fed increase the rate, Fed decrease the rate. You've seen a 5.5% plus kind of alpha in the portfolio for a 21 years of PMS track record. And to top it up, there is always we couldn't believe yet that we were locked in for almost 2 years through pandemic there. Even after all this journey which has happened, we are actually seeing that 19% compounded of wealth has been able to do in a period of time from a $500 billion to $3 trillion economy. And what we're looking ahead is a serious opportunity where the next 1 to 2 decades belong to us. Now, this is something I want to highlight, and I'm speaking today. And thanks again to Kamal. It's in my experience of at ASK, what I found is that very rarely IP last month and same this portfolio fell by 9% in a single month time. Now, what we studied is that in a 12-year period of time, IP has fallen only about 3% of the times on a rolling basis, on a month basis. Now, look at the period of time when it fallen. In the COVID first time happened, 14% fall. In April, about 10% fall. And look at there. IL&FS crisis, 11% fall. Demon, 12% fall. Taper tantrum, first time happened, 10% fall. And so is it. But look at the 1 year, 3 year returns out there. 4.7, market is negative, IP. 14 versus 1.8, 21 versus 7. Look at any period of time. 13, 74, 38%, 30%. COVID time, 41, 40, 57%. So what I'm trying to bring with this slide is there when difficult situations or times like this happen, when liquidity is sucked out of India, not because of anything fundamentally wrong, good companies with high liquidity generally tends to underperform not because of anything else, but liquidity is sucked out there and the price falls. But in the up move when it happens, that's when the portfolio is really bounced back and does well. So you must, if you have not started, then you should put in IP or EOF depending on the recommendations which your advisor will bring in. PMS AIF World Team is a great education platform. You must look at there. IP performance, again, I'll not speak about there. It's grown 7 versus 3 times. Just look at there. But again, don't focus on performance. That brings to my last slide on the presentation. And that talks about the digital onboarding. Now, we have understood the clients very well, and we want to do that. I'm so proud to tell that in a 9-year-old AIF industry, which has a 55 lakh crore kind of market cap, the overall AUM which is managed there, we are the first one in the country to bring a completely paperless digital onboarding. I myself have tried, onboarding my own self, my family, and it could actually do in 6.5 minutes. So I would urge you to consider doing a digital. All it needs is that you need to be an individual investor, and you need to have an Aadhaar, and you need to see KYC verified. There's only 3 things which are expected in doing there, and you will get a completely digital onboarding experience, which is one of its first kind. We did that last year. We launched to this, and we still continue to be the only one in the country because we believe that it is the personalized servicing which is important. On the PMS front, we are not talking about it, but today on a WhatsApp basis, I can do a transaction. I can add additional strategy. I can get my statements online. I'm a customer myself. I would love to show you. I will show you there. And we also have an app which allows you to track every single thing which you want to track at your comfort, which is available. And therefore, what we're trying to, on this part, I'm trying to say, the time has moved on. We got to think how the customer wants. At ASK, we always focus on there. So I'll just sum up with the 6 Ps again there to close it there. Always focus on the people, the philosophy, product, process. AIF is a great platform which you must consider there. But in this order, then a long track record and the personalized servicing there. So I'll stop here and then happy to take any questions which the clients would want to have there. Should I stop sharing?
Yes. Yeah. Yes.
Once.
Right, Nimesh. Thank you so much for such a detailed and I would say fluent presentation. Which kind of enhances confidence during such times. For our audience. Also, from the various questions which have been coming over chat, I have picked, this one particularly,
sure,
which talks about the fact that we have been, trying to base our argument on some of these mid-cap companies which are quality managements, and we are trying to enter them early. The industry where they are kind of prevailing has a large bond size, and hence compounding in something over longer period of time which can be seen. then why do we have a close-ended structure? Why not maybe a open-ended structure? Because at some point of time it will have to kind of wind up.
So very good question, and I think we were also debating that today the category 3 AIF on an open-ended structure there is no clarity on taxation. Okay. And we have consulted PwC, we consulted so many consultants, but there is no one clear way of saying that this is a taxation will apply there. But on a closed-ended structure, there's a clear definition of, because the pool, the number of investors is actually defined at the start. This 1,000 investors will begin with that, or whatever investor close in there, and therefore the taxation becomes capital gains there compared to in terms of an open-ended structure. We would love to do that, and one of the best ways, because we wanted to be customer friendly and tax friendly, so we chose a closed-ended structure out here. And what I may request all the investors who are having a good long-term view there, if in case, and I'm sure there's opportunities long enough, we will help you by launching a similar, if by that time open-ended structure is there, we'll do an open-ended structure or a closed-ended to benefit and participate from the same companies or some other companies at that point in time, where you can just migrate from this AIF to other AIF, so that there's a continuity there. But that's a very good question, and that I love the thought process in terms of there, that why can't we participate longer enough? But if it not been the taxation, and I have so many times spoken to PwC, if there's a clarity on AIF, long-term open-ended clarity, then I would have loved to do open-ended only there.
Sure. So currently, in Nifty 50, financial services is around 40%, and in Nifty 500, I guess it will be around 35%.
Yeah.
But given it's a mid-cap portfolio and the kind of companies that you had shown, it was not quite clear that what's the allocation of financial services as a sector. So can you please throw more light on that?
So I can tell you we are about roughly, to my knowledge, about 20 odd percentage in this portfolio, which comes into not even 20%, could be about 25, 28% out there. NBFC is about roughly 11%. The banks is about 5 to 6%. Insurance about 5 to 6%. That itself add to be able to do that. So about roughly 25% is the kind of the BFSI as a sector is there in this portfolio.
Right. Can you please also kind of elaborate by showing allocation to other important bigger sectors like specialty chemicals, information technology, pharma, consumer discretionary?
So the chemical sector is roughly about 16 to 20% in terms of the agrochemicals, chemicals across is a fairly good spread, which we have 15-16% out here. 3 to 4 names you won't believe there. And then comes in terms of the pharmaceutical is about 5 to 6% as a portfolio. Then there is, which I spoke about, the consumer durables or a manufacturing story we spoke about, roughly 9 to 10% there. Retail is about, again, 8 to 9% there. There's a great pipes, APL Apollo tubes we are trying to play with at about 6% there. So actually, this portfolio is very, very diversified. It doesn't have any concentration, lesser concentration than any other portfolios out there. As I was seeing, and if my memory holds true, there is about roughly 15 to 16 sectors. If you have to bring in NBFC as separate, if you're saying bank as separate, insurance separate, that way, there are about 15 to 16 sectors which is there to be able to play in the whole the story which we do there. And each of them will have 1 or 2 best names inside in the portfolio. And the highest maybe still continue to be BFSI with about, as I said, roughly 20%, followed by maybe chemicals and pharmaceutical mix if you do about closer to 15%, and then about 5 to 10% in different portfolios to be able to add. I hope that answers the question.
Thank you so much. So, the slide that you had shown where the overlap between, certain popular mid-cap mutual funds was shown. Can you please show that slide again?
I'll do that.
That was very, unique and kind of unbelievable.
Yeah,
we are talking about on one side quality AIF and on the other side quality, mutual funds. How come there is so much diversity?
So I was seeing AFL as a company is hardly owned by 3 or 4 mutual funds in the country. There is so many portfolio which is there. And this, I can give you a live study. I can give it with PMS AIF, the entire study which we have done there. I can show you there. And this is, just look at it. And this is a live. So you're talking of, I'll just color it here. Yeah. On an average, when you compare the mid-cap and small-cap funds in the entire country, all AMCs put together, our overlap is 7.5% of 4 stocks in the portfolio, in there versus the other there. And a max overlap, let's say 25% in, I think, one of the funds I'm forgetting, maybe it's Can Rebecca or something was there about 10 stocks. And look at the names which you most likely will have in your portfolio. It could be Axis Midcap, it could be HDFC Midcap Opportunity. HDFC Midcap Opportunity only about 4.2. What happens is we are not what you call benchmark focused. In our portfolio is, as I said, bottom-up stock selection approach. So many names which I spoke about in terms of they would not be part of the broader index, and therefore they would not be winning. Mirai, a great company, one of the finest in terms of funds there, about only 2% overlap. Look at, I can give you the entire list of a couple of hundred, not a couple of hundred, but it could be in terms of 70, 80 kind of funds which is available on the small and mid cap, and I can give you a name. But I just took the top 10, 15 ones for your comparison out there. Even Nippon India growth is 15%. So to take at best 10 to 15% commonality. But our portfolio, because we are high growth portfolios there, is always very little, because most of the mutual funds actually typically mimic the index, and therefore on an AIF and the PMS platform we are not compulsive to invest into the benchmark, and therefore you saw the disparity between the BFSI in the index versus BFSI which we have, chemical which is there and we have, consumer which is there and consumer we have, because that is where I think alpha generation comes in there in our portfolio a longer period of time. So I hope the client who asked is able to get almost a good clarity by seeing this slide, the overlaps.
And I'll tell you, because we also do financial health checkup for our clients. Yeah. The very first step, I can tell you, most mutual fund investors have this disorder in their portfolios, in the sense that these top mid-cap mutual funds are talking about, there will be significant overlap amongst these mutual funds. Absolutely. And most mutual fund investors would own more than 3-4 mutual funds amongst this list.
Yes.
So in the overall context, it will be a kind of too much duplication. Absolutely. Yeah. So your portfolio coming out to be having very low overlap, and that too coming from variety of sectors with around 20% allocation to financials, obviously makes it agnostic from the benchmark. The subsequent question, that comes to my mind is that there are always, attribution to the returns.
Yeah.
Now, over next, say, 4 years or 5 years of the, expected future, in terms of the house view of ASK investment managers, right? When an investor is investing into this particular portfolio, I know, you cannot anticipate and quote a figure of expected returns, but what are the, where does the return come from? So how do you attribute that return, kind of in terms of the growth in the economy or the underlying industries or the value at which one is investing, and hence, maybe re-rating happens, or maybe it could be the longevity in terms of, remaining invested. So what are the factors which, you as a fund house kind of want to make investor expect and believe that this is the kind of attribution through which my returns will come?
So I think, again, good question. And my simple answer would be that we always take this position of high quality, high growth. And last 21 years, we've been able to demonstrate. In the last 12 years, IP across there. And we believe that that is one space. I think we are extremely well positioned. And we believe that India is a high growth story. And with high quality, if you get in the number one. So we are typically buying into leadership company, into whether small, mid or large there, the best of the company, a great allocation. So a couple of things happen. One is the quality of the portfolio. So we say high quality, high growth. Second, what is the allocation in the portfolio? That's an important part is there to get the alpha in there. And third is what we bring in terms of the patience and perseverance to be with the thick and the thin. Okay. There were the huge temptations for Bajaj Finance in the COVID days, and a lot of managers hived off or removed Bajaj Finance. And we actually increased the allocation because we believe that was a time to increase allocation. So that rebalancing of portfolio, which we do, allocation, initially I said, but rebalancing is an important element. And I think we'll continue to do that and let the market decide in terms of who want to do and who recognize. For the last few months, we're not looking good. But not looking good is always happens. As I showed you in IL&FS, I showed you in terms of Demon crisis, I showed you in COVID crisis. It always in terms of there's a money pulled off from a high quality, high growth market, and then moved into other. But as soon as the markets start to recover, I wish I had the other slide, which I had shown Asian Paints, Kotak, PI Industries, Britannia over a longevity of 21 years, how it falls and how it really bounces back, it shows there. So we will continue to do that. irrespective of market cap, what is there, high quality, high growth is something we believe we stand for, and that is the one which will create long period returns in this growth opportunity inside of the country.
So one of the important facts mentioned on the very first or second slide of any presentation of ASK talks about your philosophy as wealth preservation and wealth appreciation. I have not seen any such comment so outrightly and confidently mentioned by any other equity fund manager, because ASK is one of the thought leaders having more than 2 decades of presence, and obviously I think giving services to almost every HNI in India with more than 40,000 crores of assets overall. So I am really keen to get answer from you that what makes you so confident in your philosophy, where you quote it that you want to first preserve capital when it comes to investing in equities.
So I'll give a test match example which is there. I don't know what's the score is in India England today, but the lesser number of wickets you lose in terms of there and the longevity you stay into the test match, I think that wins you. Similarly, I can say ASK, and that's my personal learning also, which I would like to share. It is not the number of multi-baggers you have in the portfolio which creates wealth. It is a lesser number of mistakes you have in your portfolio creates long period compounding of wealth. And that's a very deep understanding, a profound learning which each of us do there. We always endeavor to run faster, but the approach in market should be more slower, more in terms of holding on to it, buying into good and staying long enough is there. And that is where we've seen over cycles. And as I said, Bharat have seen over cycles is to be able to have that patience, temperament, sticking to quality and preservation. Again, saving your runs. I always say, when I was talking to a Surat investor, I told him 100 rupee comes down to 80 rupees. How much percentage? He said 20%. I said, no, it is 25% you need to go there. And if 100 rupees drop down to 50 rupees, any idea how much they will take there? He says again 50 rupees. I said, no, it is 100% growth it requires. So if you need to fall lesser, okay, the propensity for you to bounce back is and be creative long period compounding is very high. And so remember this thing which I shared right now. And we at ASK are proud. You may have not seen very unique names come out of our portfolio, but I can promise to you that we've done the least mistakes in the last 21 years. And a manager who does lesser mistakes is the one who on the longer term has been able to consistently deliver the performance there. So that's something I wanted to share here.
So, Nimesh, you started by taking the name of Mr. Bharat Shah, who is a thought leader. And I think, one of the most strong pillars on which ASK is standing. Yeah. And as of now, in the last question also, you have taken his name. Yeah. So we also know last year there was an event, that kind of changed the management for ASK.
Sure.
What is the kind of role that Mr. Bharat Shah plays today in the new structure?
Sure.
And how is this new structure, coming out in the context of overall working and processes? Because it is kind of evident and known that some of the promoters have actually reduced their stake, and some of the promoters are actually no more a part of ASK.
Sure.
So could you please throw clarity, because there are questions around in chat around this.
Fantastic. Again, a very relevant question comes to a customer's mind. So happy to do that. So first and foremost, we always had a private equity company named Advent, which was about close to 49% in investing in the company. So from 2016 onwards, they were the PE investors. So half of the company was owned by them. Then came in times. So Blackstone took about 71% stake, but they are the financial investor. They are not strategic investor. What I mean by financial investor is the PE fund of the Blackstone, which has taken a stake into the company. So they are financial investor, not strategic investor. What they may do is over a period of time, maybe in a ASK will go to listing IPO in about 3, 4, 5 years, 6, I don't know when time. And they will then exit and the promoters will continue to do the show out there. You are right in bringing out there. So therefore, just to come on there, what they very clearly said is there that you are great at investing into public market. They don't have public market investing. They are unlisted play. They are real estate play out there. And they say we can, in terms of add value, in terms of marketing, branding, offshore money, which comes out there because Blackstone has a great name out there. So offshore investment coming into the country, the expansion can happen in the country. We actually, one of the reason if you've seen the new logo of ASK is a function and effort of the Blackstone team working. The Landon & Fitch, which was the marketing company, brand company, worked with us and created. So that is a value add there, and left it to Bharat Shah and team to do the investment because they're saying we don't have the competency. We'll add. So it's a complementary skill which you wanted to bring in there. Apart from investments we have, we continue to do that. To talk about it, you talked about one of the promoters. Yes, there was Mr. Asit Kotecha. Because of he ran his 3-4 businesses independent also. He had a real estate business, he had a salon business and all. And due to challenges on his personal business, where he had created a huge debt, he actually sold off his 16% of the company. So 49, 50% plus 16%. So it became 66%. And then it is about 20, 30% of each of the shareholder of the company gave back to the Blackstone. And therefore it became a 71% stake. But Samir Bhai, which has been again along with Asit Bhai, continues to hold a very large stake in the company. Bharat Bhai becomes I would now say, the third largest holder in the company now. Okay. And I'll quote Bharat Bhai when I was talking and Samir Bhai both together. It's a Gujarati, but I'll explain first. I'll say in Gujarati. Eke advent avse jase, Blackstone avse jase, but apne 10 વર્ષ, 15, 20 વર્ષ માટે do. So let me say, what it says is advent will come and exit. Blackstone will come and exit. But we have to think for our investors for the next decade, next 20 years, how we need to serve and make it bigger. So that tells us the mindset, and that tells us how we chose to work with Blackstone as a partner and not others. And we are happy that Blackstone chose because they are a great financial investor. They will add a value. It's a complementary to our business. Then actually in terms of, influencing on the wronger side, it will not. And, just to tell you who has come on our board, which you must know. All of you know Mr. Milind Barve, somebody who founded the mutual fund industry in terms of he comes on the board with Blackstone. So, in some way I have to report to, imagine the man who know everything in the industry today. He's on the board there. Nitin Rakesh, Emphasis CEO and MD, the current CEO and MD, he's there. Girish Paranjpe, ex-CEO, Wipro and HUL is on the board. So the board which comes in there with expertise, it actually brings in a lot of experience. Therefore, again, we can say we can do lesser number of mistakes as we move forward. And that, I think, will be a value-creating trait or things which the investor should look forward to working with ASK.
This is the last question, with regards to ASK, EOP, AIF that we're talking about.
Yeah.
What is the allocation to large caps and small caps? We have predominantly, spoken about that it's a mid-cap focused portfolio. Yeah. But what will be the allocation to small caps?
So I'll do that. It's perfect. So 64% today is mid caps, about 18% is small cap, and 18% is large cap, as on the portfolio build. So 18, small and large is 18%, and mid cap is 64%. So 82% is small and mid cap, and 18% is a large cap, as on the built up of the portfolio, which is today.
And as you will raise the further commitments and the overall portfolio gets built, is there any I would say thing mentioned in the PPM or offer document in terms of the target profile of the end portfolio in terms of market cap?
No, so our all portfolio are flexi cap fund. If you look at this, also the flexi cap with no biases out there. But as it stands, as I said, it will be upwards of between 60 to 80% in the rate of small and mid cap. Okay, in that range. And then at times it can have a large cap allocation a little more, but in between 60 to 75% would be the offer document talking about having into mid and small cap.
So let's assume you have a large size mid cap company. Yeah. For example, you talked about Pidilite, yeah, or maybe any other large size mid cap company, and then over a period of time, over say 2 years, it becomes a large cap.
Yeah.
So will that remain in the portfolio, or you will change that?
Excellent question. Good for bringing up there. So when we say this, this is the time of getting inside. So PI industry, when he got inside in 2013, 14, or in that year, it's a 1,000 crores portfolio market cap. But today is 40,000. We still continue to own. So a very good point you highlighted where investors should know. As we stand today, it is like this. But just suppose it becomes a large cap by chance. A mid cap became a large cap. We don't exit there. Because you come in there and what the start also said, we're buying early to small mid cap, it will become large cap of tomorrow. So why should I exit for that? So the answer is there. At the time of entry in the portfolio, it will be a small and mid cap, and then it can either ways go higher, become a large cap.
It reminds me, my Citibank days when your IEB portfolio was launched. I remember, that time that portfolio was also mid cap biased.
Absolutely.
And today it's around 55-60% large cap.
Absolutely.
We have seen, it giving returns around 19-20% CAGR over last around 10-11 years.
Good
So
observation.
looking forward to similar kind of returns from this fund. With this, we come to an end. Thank you everyone today for logging in, and thank you Nimesh for your time for this interesting and intuitive presentation. Thank you everyone.
Once again, thank you for doing this education event again and again. Good job, Kamal and the PMS AIF team. Thank you all. Bye.
My pleasure.